This is Dr. Tom Carr, a.k.a. Dr. Stoxx at drstoxx.com. That's drstoxx.com. And I'm coming to you today live from the live trading room. This is a service I started back in 2019. We've been very, very profitable all the way through. You know, a few hiccups along the way, but we've been profitable nearly every month. And most days we close in the green. And if you want to join me and a big group of amazing people, and everybody's got the rule for me not to share politics and not to swear. Just two little things that I like to keep. I keep the room nice and orderly, and it's a great place to hang out through the trading day. Got some people in the room who have not traded much before, who have traded for years and years, and everybody in between. And I tell you exactly what I'm trading. I give you my ticker symbol, entry price, stop price, target price, reasons for the trade, technical chart, updates along the way until I close it out. And I share with you, too, what's going on in the market. Anyway, this is our once or twice a week I jump on the live mic, do a little bit of trader training, some chart work together. And we're going to start by going over to, if you want to join us, I forgot to mention this, go to the subscribe button, scroll down to the live trading room, and if you want to add on our new live options room, you can do that, although we're now just about into our second year with that service. We can do that at a 40% discount. Okay, so today is Tuesday, the 6th of January, 2026, brand new year, and I'm going to talk a little bit about the last year we just had, kind of wrap it up a little bit and talk about what were some of the opportunities and some of the risks that we were presented with. And this is in anticipation of my appearance tomorrow. Sorry. In anticipation of my appearance tomorrow on the IBD Live podcast. I will be sending everybody in the room, both rooms, a link to that. I don't have it yet, but when it comes to me, I'll give it to you. And it will also be recorded, and it will be in YouTube, and then I'll send you a link to that also. But it's free, it's open to the public, and it's live tomorrow afternoon. It starts at 5 p.m. Eastern Time on Wednesday, the 7th of January. And I'm going to do two things in that time. I'm going to go over 2025 briefly. I'm going to look at 2026, which we just started, and I'm going to give kind of a map. Not exactly what I think the market is going to do, but some of the challenges that the market will be facing and some of the opportunities as well. And then I'm going to go over some stocks that the last time I was on the show, and I was on this particular show, this podcast, 1 year ago, almost to the day, and I presented a whole bunch of stocks for 2025. I'm going to do the same thing for 2026. Most of those stocks did really well because it was a pretty decent market, other than that bear market crash, which lasted about 2 weeks on the Trump tariffs, and that happened in March and April, and then it was right back up again to all-time highs. And some of the stocks that I mentioned are still actionable, still good buys, and some are holds, and there's one at least that I would just avoid altogether. So we'll talk about those. And then tomorrow, over in the live options room, I'm going to go over the stocks, and I'm going to propose for 2026. So you'll get that in both rooms, both days, and then you'll get it live all together tomorrow evening at 5 p.m. All right. So S&P 500, 2025 had three things that kind of framed the macro environment against which we were trading. One is that the Fed made this pivot, right, from hiking to cutting, and not just cutting, but also what's the phrase? Measured easing. They call it measured easing. So they're not exactly going out and buying a whole bunch of bonds, which is what they typically do when the market's in trouble and when the economy's in trouble. Neither of those two things were the case, but they were reducing their speed at which they were selling bonds. That took off some of the pressure. And then they also did a couple of things behind the scenes to kind of increase the liquidity of the bonds. And unfortunately, it hasn't had much effect at all on the bonds, because the bonds have just been in a dismal bear market, and I don't see any end to that anytime real soon. But that was a big part of it, right? So that happened kind of late 2024, early 25. I'm going to have to find out for the actual show the exact dates of that, but you can see the effect, right? Late 2024, early 2025, trading range here in the first few months, and then it hit all-time all-time highs in the middle of March. And one of these red bars in here, again, I'm going to have to figure out the date, was when Trump came out. This is the second thing. Trump came out overnight unexpectedly saying, I'm putting a 10% tariff on every import that we bring into this country. Now, when you think about that, everything that we ship in from China, every brie cheese and wine from France, I don't know what other countries you get stuff from. Mexico gives us a whole bunch of stuff. Canada gives us a whole bunch of stuff. Maple syrup from Canada, right? Whiskey from Canada. All those things were going to be suddenly increased in price 10%. That's inflation. Market doesn't like inflation. And it squeezes margins. It means everybody and their uncle has to raise their prices, and that slows down demand. It looked really bad, right? Now, the market kept pricing in the worst case scenario for that. And then Trump announced, probably right around here, middle of March, said, hey, I'm going to announce on public television, I'm going to call it Liberation Day, I'm going to announce my plan for the tariffs. And everybody and their uncle at that point was kind of fearing the worst. And now we're starting to think, maybe, he'll kind of clarify, he'll reduce over here, he'll take some tariffs off other parts of the market. He'll do something that's really market friendly, right? Because the market is already down at this point at 10%. And so that's when we started to bounce back up a little bit, hit the 21 period moving average, the 200 simple moving average, and then it was Liberation Day to the downside because that wasn't an alleviation of tariffs, it was making it worse. The numbers were higher. The number of countries applied higher. And then, of course, the market panicked, absolutely panicked. Here's the night after, right? This is April 3rd, the night after he had his Liberation Day speech. It was down all the way down here. Now, if you look at the numbers from the February all-time highs down to the lows of the tariff panic, you've got, let me see, I've got the numbers here somewhere, 25%. I should have the numbers, but I don't. 25% for the S&P, 28% I think for the NASDAQ. It was 30-something percent down off the all-time highs for the Russell. The Russell set all-time highs back in 2024, but it was already down a little bit. So that's bear market, right? That's bear market territory. One of the fastest, shortest bear markets in history. And the reason why it flashed back up so high and took a couple of weeks to kind of get going again was because during that time people began to realize, really, when you think about it, we should have known this from the start. And the market just didn't, it just panicked. But we should have known that these were negotiating tactics, not actual tariffs that were going to destroy the American economy and raise prices and inflation and all of that. No, he's just bringing people to the bargaining table. This is how he does it in the art of the deal. This is how he's always negotiated. He lays out the hard hammer, boom, 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 boom. You're in big trouble now, boys. And then he backs off. He backpedals. There was even a phrase for that, taco, right? I forget what taco stands for, but we were always saying in the room, oh, it's taco time again, taco time. He's scaling back the tariffs over here on China and scaling back the tariffs over here on Europe, giving people more time, et cetera, et cetera. The market figured out, this is negotiation. Then we're right back up, right? Right back up. Nice 30, 35, 40% rally in most stocks for a 6-week period. It cooled off a little bit here in the middle of June, and then it was a nice big leg higher to all-time highs. And from that point on, we've had a modestly bullish market, modestly uptrending market, but there's been some pullbacks all the way down to the 50-period moving average once, twice, 3, 4, 5, 6, 7, 8, 9 times, down to the 50-period moving average. That is not a strong uptrend, but it is still an uptrend. And so these dips that we've had, and they've been on various things, disappointment with the Fed, they've not cutting fast enough. We did get 3 rate cuts since the Fed started cutting rates, but market wanted more. Some earnings. And then the third macro for 2025 that had the market reeling a bit on earnings was the CapEx expenditures for the big blue chip tech stocks. They're all coming out saying, well, guess what? We're increasing our spending on AI infrastructure and new chips and faster cooling systems and blah, 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 right? And that had the market worried because these companies are spending too much money and we don't really know what the payback is just yet. Right? We're seeing a lot of investment, not seeing yet a lot of return. So that was the third thing that market has been trading against. And the tariffs, I think, are pretty much of a done deal. They'll start to wind down. People don't even talk about them much anymore. And the Fed is still going to be cutting rates. We'll probably get 2 more cuts this year. That's also a positive macro for 2026. But the third thing that started at the end of 2025 is still with us and will likely be with us for a while. Now, let me talk a little bit about 2026. What do we see ahead coming in 2026? In terms of my math, generally speaking, I'm going to say, just in very general terms, we're going to have a tight, choppy, fairly trendless trading range kind of market for the first 6 months, and then a much better uptrending market in the latter half of the year. We might even push that back, not just to like the end of June, but push it even back to August or September. Part of that is the midterm elections. We'll talk about that in just a minute. But the CapEx spending, let's just talk about that. So in 2025, the Mag 7 and a handful of other blue chip tech stocks spent $350 billion on AI investment. And that is 75% of what they typically spend on CapEx in any given year. 75% all going in one direction, and that is, building data centers, building out the gigacloud, hyperscaling this and that, finding the cheapest, fastest semiconductor chip that is also not overheating all the time. There's an interesting science with respect to the chip. Right? If you talk to ASML, for example, they're the ones that build the machines that build the chips. And they've got this massive machine, extremely expensive, that is now building the smallest, fastest, strongest processing chip in history. But they're out saying now that the infrastructure of the chip, that the bottom layer of the chip, which is where the electrons move around in channels to generate the power of the processor, which lies up on top of it, they've got these channels so narrow that now the electrons, as they're moving past each other, they're interfering with each other's movement. Right? Quantum mechanics in action. So you can only get it so small. I think there's a limit unless we find some other way of making a chip, as to how small and how fast these chips can be made. Anyway, that's beside the point. So 2026, companies have already pledged to go up to 500 billion, maybe even 600 billion of new AI investment in their CapEx budgets. So that's a big boost. Now, analysts have looked at those numbers, and now that we've kind of had several months and months of CapEx expenditures and kind of figuring out what does that translate to in terms of, hold on a second. Make sure I can see what's going on in the room, just in case. Okay. Now that we can see how that investment is starting to pay off, right? Data centers are doing stuff, and people are using AI, and now they're making companies a lot more efficient and faster and better for the customers and all of that. Then we have a way now of calculating how much that extra expenditure should raise earnings for, let's say, the top 50 S&P 500 tech companies. Let's just take those. 30% is what is estimated. So if we take every tech company, and calculated what they earned in 2025, and then we increase the CapEx spending up to let's say 500 billion from 350, that should give us an extra 30% of earning power in those companies. That is not insignificant, and that is, in fact, if that plays out, that is a very bullish thing. That's going to lower valuations. That's going to give companies even more money to spend on infrastructure, and yeah, it's just a win-win all around if that plays out. Now here's the one red flag. If that doesn't play out, the market's not going to be happy, right? So we'll see it play out probably second quarter, third quarter of 2026 as they start to announce their earnings after spending all that money, and we'll see what has that done to the margins. Okay, second thing that is 2026, we should get 2 more rate cuts. We probably won't get any until after Jerome Powell resigns. That's in May, unless we get something falling out of the jobs market. We get horrible returns in the stock market. Earnings are just dreadful. We see the ISM numbers slip below 50. I don't think any of those things are going to happen, and they certainly haven't happened yet. So, in the absence of something horrible happening, we should get no rate cuts between now and May, and I think the market is okay with that right now. It's not exactly what they want, but they've made their peace with that. Powell gets out, and some guy comes in that Trump really likes and who is in favor of cutting rates the way Trump wants him to. If that happens, you're going to see a second half of the year, 2026, skyrocket, because liquidity pumps money into the market and into companies and into consumer loans and into car loans and into mortgages, and you're going to see all those rates come down, and you're going to see spending go way up, and that will fuel a very nice rally in the second half of the year. That's why I'm saying the second half it should be better. If we don't get that guy, or we get some guy that says, yeah, I'll do that, and then he gets into the office and doesn't do that, because that happens in Washington, then the market, I think, will really struggle in the second half. Now, the third thing we need to realize is that the economy is in pretty good shape, right? GDP is way above expectations. The jobless claims have been staying well below that 240 threshold, right? The 4-week lagging indicator is something like 218, 217, and last week's was well below that. I think this week will also be pretty tame. So we're not seeing a flush of people going to the local office. What do you call the office where you file for jobless claims? I don't know. The local tax collector office, something like that. And we're not seeing that. And there was kind of predicted that would happen with AI taking over jobs. Well, we haven't seen that play out just yet. GDP was 4.3%, well above expectations. ISM Services, PMI, which is a very good read on recession, has been well above recessionary levels. 50 is the cutoff. We've been in like the low 50s, 52, 53. Those are good numbers. FedEx, UPS, both double beats, raised estimates. They're doing well, much better than they were. Trucking companies are listed at the top of the S&P 500. Trucking companies, logistics. Things are moving, right? People are buying stuff. People are out there making stuff. So all that's good. And travel companies, like Expedia, Southwest, Delta Airlines. These are companies that are up at, their stocks are up at 52-week highs. They've been in great Momo mode. We're long jets in the live trading room. And I think we are, right? Didn't we? I have to figure that. Yeah, I think we're long jets. And yeah, so those are indications that the market, the economy is doing well and should continue to do well. Now, here's a couple of red flags, and I'll do these really quickly because I'm running out of time. First of all, we are well above standard deviation. If you look at the weekly chart on the S&P, we're well above the 200-period moving average. We're well above the midline of the standard deviation, 1.5, 2.0, whatever you want to look at. And we're really way up there in terms of historical market tops, okay? So, for example, just before the tariff crash in March and April, the S&P 500 was 34% above the 200-period moving average. Just before the COVID crash, it was 31%. In 2007, just before the subprime mortgage crash, it was 23% above the S&P 500. Now, it had already been kind of coming down at that point. Where is it now? Guess what? It's almost 40%. We're almost 40% above the S&P. Now, just because you get high numbers before market crashes doesn't mean that you get market crashes when you have high numbers, right? Correlation is not causation. That is always true. But it is a little bit of a red flag. And what it probably means in terms of my thinking and as a technical analyst is that we probably aren't going to see a rip-roaring bull market for the S&P and the NASDAQ. We'll see a trading range instead. It's not going to be a bear market. It's not going to be a major pullback. Probably 4, 5, 6% along the way, but really every dip down to levels of support should be bought because I think the economy should support that. Okay, that's red flag number one. Red flag number two, and this is true, and it is a big concern to those that care about this kind of thing. If you look at trailing PE ratios for all the S&P 500 companies, it's up close to 30, 29.5 times, 29.5 times what companies are earning. That's a premium we're paying for the stocks, the shares of their companies. Now, the historic trailing PE go all the way back to 1950. The historic trailing PE for the S&P 500 is closer to 20. We're up there at 30. It's closer to 20. That's the average. Okay, that's a little bit of a concern. We're paying a premium, right, for stocks that are a little bit more expensive. Warren Buffett is not happy with that. That's why he's raising all kinds of cash. But look, we're in a much different economy now than we were back in the 1950s, and 60s, and 70s, and 80s, and even the 90s. We're in not a manufacturing economy anymore. We're in a goods and services economy. Everything now is tech-based, and now it's becoming even more that because of AI. And you've got to think about companies not in terms of how much they make, but in terms of how fast they're growing. And for that, you pay a premium. We always have had to pay a premium for growth companies. So the S&P 500 now just has more growth companies than it used to. So that would explain it. Okay, that's, again, a little bit of a red flag, but I'm not going to be too worried about that. The midterms are this year. And unfortunately, every midterm year seems to add some fluctuation, some volatility into the market. Some of the worst years of the market happen during midterms. In fact, 86% of all the down market years for the S&P that were 10% or worse happened during midterm years. But again, it's correlation. It's not necessarily causation. Bad years do happen to be midterm years, but not every midterm year is a bad year. In fact, more than the average of them are positive, just not hugely positive. So the midterm year, if you look on average, it is a positive year on average, but it's just not a big one, maybe 2 or 3%. That's one good news. As I said, I think, again, it's going to be tight and choppy for several months. And then when we get into Fed chair and earnings coming out, and we start looking past the midterm elections, however that plays out, then the market should get happier at that point in the latter half of the year. Also, after the midterm, and going ahead for the next 4 or 5 months, rather, like from November through April of the next year, is one of the most bullish periods of the whole presidential cycle, right? And another thing, too, the second term of the president midterm election year is generally, on average, better than the first term of the midterm year. Okay, so I think we had COVID in the president's midterm. No, COVID came after that, right? It's 2018. Anyway, okay, so, and then the last thing I should mention, and this is an interesting historical piece of information, but you probably don't really want to focus too much on it, and that is that we're seeing this very rare event take place in the gold and silver markets. It is very rare to see gold and silver together within a 2-year span triple in value. That's exactly what they've done since early 2024. They've gone, I don't know what it was, 1,000 for gold to 4,000. Silver was like 20 or something, and now it's 75 to 80. They have tripled in value within 2-year span. We've seen that 5 times in history, only 5 times. And the first time was way back in the Roman Empire. I wasn't trading back then. I know I'm old, but I'm not that old. The most recent time was 1931 during the Great Depression. Prior time to that, 1880 something in England had the same phenomenon. They went into a horrible depression. Time before that was 1600 something in the Netherlands. They went into a horrible depression. So if we look at those 4 instances that precede this one, in all 4 of those instances we see that the rise in gold and silver correlated with horrible things going on in those countries. Right? The loss of the Roman Empire, the collapse of Western civilization as we know it, blah, blah, blah. Okay, so this time things are different, and I'm going to give you some reasons why it is different. And I don't think we need to worry about a major collapse in the economy just because silver is doing really well. It's an interesting note historically, but I don't think we want to trade on this. And here's what I think is going on. So gold and silver, I think, are going to be maybe the best trade for 2026. They were easily the best trades, unless you got into you bought Micron and SanDisk and WDC, Western Digital, and Seagate. If you bought this Seagate Tech, if you bought those 4 stocks because you knew that the storage sector and its contribution to data centers and AI was going to explode in value, then you got in on the best trade of 2025. Yeah, bar none. But if you missed that one, we didn't. I was in Micron. I actually talked about Micron in my first in the IBD podcast 1 year ago today, and then it didn't do very well because of the tariff crash. But it went from 100 down to 60, and then it went from 60 to 300. Okay, so it did have its moment. It just had to get past all that tariff stuff. But gold and silver is the second best, right? And you can leverage that, as we do. We like to play with gold GLD calls, SLV calls. We're in SLV calls right now. We leverage that with the mining companies. We took to look at the 2X, the 3X versions of gold and silver, the mining companies. I would even extend it to copper and to platinum. Copper is the poor man's silver. Platinum is the rich man's gold. And both platinum and silver, by the way, and now copper, play big roles in the coming economy. Both solar panels, solar fuel cells, hydrogen fuel cells, and these are the things that are going to be needed to drive the energy demand of the data centers. So I just don't see anything lightening up there with gold or silver. Buy the dips and hold through the rips, and I think you'll be in one of the best spaces for 2026. Now, why is silver and gold? Why are they both so strong? There are several reasons, I think, and all these point to something that is maybe a little bit off with our economy, but not necessarily a game changer, not necessarily lights out, right? One is that we've lost some confidence in the U.S. dollar. I don't know exactly why that is. There may be some political stuff going on with that, but foreign countries, central banks have been selling their dollars. Dollar's been weak. That props up gold and silver. We've lost confidence, I think, to a large degree in crypto, right? Bitcoin was the big thing. All my daughter's friends for years were interested in Bitcoin, and if they couldn't afford it, they would at least pretend that they were buying something, and they were buying all these other little, the Dogecoin and things like that. But I don't think there's much demand that much anymore. Now, maybe it's not necessarily the end of Bitcoin or Ether, and maybe it's because governments are over-regulating, and that's partly true. But so demand coming out of Bitcoin and Ether and others going into gold and silver as a stronger asset class. It's the end of big bank manipulation. J.P. Morgan just got slapped on the wrist for manipulating silver prices for so many years, and they admitted that they did it, and they're paying the fine for it. But now that that's out in the open, they can't do it very easily anymore. So with their hands off, we should see gold and silver especially return to a better valuation. The supply is being shut down. This is especially true for silver, lesser extent for copper and platinum, but governments around the world are regulating the mining industry because of environmental concerns, right? So you've got to go through a gazillion layers of red tape in order to open up a new mine, and companies don't want to do that, and the mines that they are now working They've been working for years, and they're starting to get tapped out. So the supply is falling, and that, of course, is raising prices. And then, as I just said, the silver, platinum, to a lesser degree, copper. Copper is a big part of the housing industry. Gold is not necessarily an industrial metal, but the other three are. And platinum and silver especially are used in fuel cells, in catalytic converters, and they catalyze chemical reactions that are important in the development of hydrogen energy. So yeah, the demand there, because all of those things are increasing the demand for silver. Copper can be used for some of that, and it's a lot cheaper, and companies are wanting to save on that, are going to copper. But those, yeah, they're just going to stay strong as far as I can see, long time. All right, last thing I want to do with you guys, and then I'll just show you a few stocks on my greens list, and I apologize, you won't be able to look at chart requests this week. But as normal, when I can't do that, you can type a ticker symbol in the trading main room with tag my name, and I'll take a look at it. I'll post a chart in the room for everybody. Okay, so let's look at a few stocks. So back 1 year ago, I was on the IBD podcast. I recommended this guy, AXON, and this is back in right around in here, early to mid-January, and it went way up, and then it went way down, and then it went way, way up, and then it went all the way back down again. And it's pretty close to, now it's around 500 something. It's pretty close now, a couple of big days, but pretty close to where I said to buy it. It's a drone surveillance company that has military application, and they also have 90% of all the police forces in the United States have a contract with them. They do, they go out into a crime scene, and they send drones up into the air. They've got cameras on their armor, and they've got a cash cam in the dash cam. You've got a dash cam in your car, and those are all made by AXON. They own the patents and all that stuff, and now they're expanding over into Europe. I think it's a good long-term investment, but man, it's been a wild ride. I didn't anticipate that at all. Another one that I would say it's a hold. I'm not so sure I'd be buying it unless I would just wanted to trade it. I think it's been a very good trade. Here's one that I really like a lot, and I still like a lot, ENE. This is you can see it's had a really nice chart. Yeah, everything went down in March and April on the tariffs, and then it's been up. It was down here at 320, it went all the way up to almost 800. That's a big move in just several months. This is a company that designs data centers. They are the architects for data centers, and they own several data centers themselves. So they're kind of landlords for certain data centers. It's a very profitable business, and there's no real end in sight for this one. And of course, they're always looking to make data centers more efficient and scalable and all of that. And they're really good at that. There are about 3 companies that do what they do. This is the best of the 3, in my opinion. That's a buy, it's a hold, it's a sell your kids and buy as many shares as you can. Just kidding. Howmet is another one that is, it should be, I think, in everybody's long-term family fund. It's in mine as of 2023. So Howmet is a industrial defense contractor, and they own the patent on the lightest metal ever invented by man. The lightest and the strongest. It's lighter than aluminum, it's stronger than steel, and we now use it in almost all of our fighter jets. Every new fighter jet has Howmet steel as part of its infrastructure. So yeah, look at this chart. Just beautiful. After the tariff crash, 109, and here it is today up at 215. And it's just beautiful. Every little dip is bought, and I don't see any real end in sight to that. This is the one I would avoid, HubSpot. Just too much competition, right? This is a platform for people trying to make money online, and they do marketing, and they do payment stuff, but just too many other companies doing the same thing, and they're not getting much traction. And I would still, as I said, buy some gold. UGL is a good way. SHNY, which is a 3X, also good. I would buy, if you're looking for a minor, I like AEM, I like Hecla, and a GFI. Those are my three favorites. And then Micron, which I recommended back in January, and I'll show you what happened with this guy. So I recommended it right here. It was about, it was just under $100, for $98, $99. And it was in this trading range. And I'm thinking to myself, man, what a dumb, you know, it's old school tech, and it's not getting much traction, and got these other great companies like NVDA and AMD getting government contracts and all kinds of stuff. And here's the little Micron just kind of plodding along. And then when the tariff crash came, of course, it dropped all the way down to 60-something, low 60s, and then it was just off to the races from there. It went up over five-fold. It was, from 60 up over 338. My goodness. All right, so if you are not in Micron, shame on you for not watching the IBD podcast. And if you are, just hold it. Don't sell it, hold it. So this storage space is not going away. UBS was just out 2 days ago, or yesterday maybe, saying, yeah, we've got the clearest, strongest visibility going forward on the growth prospects for this storage space than we've ever had in the tech world. 2 years, you can see it is not going to abate for 2 more years. That's UBS. I don't think they say that kind of thing lightly. So your three plays here are Micron. Micron as a whole, I would let it buy the dip, but I think it's a little bit stretched. STX is the one I like a lot. Oh, it's a big up today. Doggone it. I was going to buy it yesterday, and I just didn't. Big green stick, so you know my rule on big green sticks. Wait till it cools off. You'll probably get a better entry tomorrow, next couple of days. This company was founded by not somebody I know, but we lived in the same town, and he was near. It's like the next town over, and some of his grandkids, I guess, or nephews and nieces, they went to high school with me, and they founded the company back in the late 70s. They were making these kind of space age headsets, so people working in the same company could talk to each other without plugging into a microphone. I'm plugging into a telephone, and that was like a big deal. And then they kind of expanded from there. Now they do hard drive. So STX and what's the other one? STX and WDC are very similar. Right? They're about the same size. They have about the same valuation, same kind of growth numbers. And they make very similar products. The one difference here that I think gives STX the edge is that, first of all, STX has a better sales growth in the last 3 years. So they're doing something right. They're positioning their products in a better place. But here's the key difference for me. STX makes hard disk drives primarily aimed at the data center sector, and the WDC makes hard disk drives, very good storage units, great products, but they have all kinds of applications. They're in telephones, and they're in personal computers and tablets and things like that. So they're kind of more diversified, whereas STX is kind of throwing all their eggs in one basket, but that basket is just going to keep growing, right? 600 billion potential this next year. So I think STX will probably have a better year. WDC had a better 2025. I think STX is going to reverse that in 2026. All right, guys, I'm going to let you go. I'll record this, put the link in the both rooms, and then we'll get back to trading the last hour. I've got a couple of trade ideas, but we're a little bit full up in this room. They'll probably go over in the options room. God bless everybody. We'll see you back in just a little bit. Bye for